Ladies and gentlemen, good day and welcome to Quess Corp Limited Q3 FY23 earnings conference call hosted by IIFL Securities Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vidit Shah from IIFL Securities. Thank you, and over to you, Mr. Shah.
Thank you, Neerav. Ladies and gentlemen, good morning, and thank you for joining us on the post-results conference call of Quess Corp. It's my pleasure to introduce the senior management team of Quess, who are here with us today to discuss the results. We have with us Mr. Guru Prasad Srinivasan, Executive Director and Group CEO, Mr. Kamal Pal Hoda, Group CFO, Mr. Lohit Bhatia, President Workforce Management, Mr. Pinaki Kar, President Global Technology Solutions, and Mr. Sekhar Garisa, President Emerging Businesses. We'll begin the call with opening remarks by the management team, and thereafter we'll open the call for a Q&A session. I would now like to hand over the call over to Mr. Rajesh Padmasali to take proceedings forward. Thank you, and over to you, Rajesh.
Thanks, Vidit. Good morning, everyone, and thank you for joining our earnings call today. The information and data shared by the management during the call could be forward-looking, but subject to prevailing business conditions and government policy. All forward-looking statements must be read in conjunction with the risks company faces. I will now hand the call over to Group CEO, Guru Prasad Srinivasan.
Thank you, Rajesh. Very good morning to you all. Our Q3 FY23 result, and thank you for joining for us today. The business environment for the quarter was muted across all sectors, with exception in segments like BFSI, manufacturing, and FMCG and FMCD, where we continue to see some traction. We added over 80,000 headcount on year-on-year basis, a 20% increase. Please note, this number does not include an additional 35,700 FTE who were payrolled in the month of December, who were not on our rolls at the end of, by the end of the month. The backfills made during tough market environment in Q3 has again demonstrated our capability on solid hiring process that we have built over years. At Quess, our major focus was on SG&A reduction across vertical. As a result, our SG&A declined to 5.7% of revenue from 6.2% of revenue in Q2 FY23. Even though the overall headcount stayed flat on quarter-on-quarter basis, operating asset management saw a headcount increase of 3%. Our matured businesses have all continued to demonstrate growth, driving our consolidated revenues up by 21% year-on-year and 4% quarter-on-quarter basis. The consolidated EBITDA for the quarter was 145 crore, an 8% quarter-on-quarter increase. EBITDA margin increased by 10 basis points, driven by focus on cost reduction. This contributed to margin improvement across all three platforms. OCL EBITDA ratio was at 45% for the quarter and 60% for 9-month FY23. We expect to achieve 70% OCF to EBITDA for FY23 on back of strong collections in Q4. The sales engine continues to perform well. We acquired 203 new customers in Q3. The cross-sell engine continues to hum with 45 wins in Q3 and with an annual contract value of 349 crores. For 9-month FY23, cross-sell team has won a total 70 contracts with an annual contract value of 532 crores, which is what we added in entire FY22. Quess has also partnered with Boston Consulting Group to work on few strategic review and planning exercise with goal of sharpening our business and capital allocation priorities. Now coming to platform specific updates. Workforce management. The platform posted a revenue growth of 4% quarter-on-quarter and 21% year-on-year. Workforce management added over 100 new clients in the quarter, continuing to 100 plus customers in addition continuously in a streak of 7 quarters in a row. The demonstration of sales capability of our team in this challenging environment is quite commendable. Workforce management headcount reached 379K, an increase of 25% year-on-year. Driven by over 50K headcount additions in H1 FY23, GS revenue, the general staffing revenue, grew by 7% quarter-on-quarter and 25% year-on-year. The business added 56 new logos in this quarter, taking the 9-month new client addition to 179, and the per associate per month gross margin profile stays stable around 690 rupees per person range. Value-added services in general staffing contributed 21% of general staffing gross revenue margin against 19% in Q2 FY23. EBITDA from operations grew by 6% year-on-year and 9% quarter-on-quarter. The EBITDA margin saw an improvement of 11 basis points quarter-on-quarter. This is largely attributable to the efficiency improvement in general staffing, which achieved its highest ever associate to core ratio of 1:4 and 459. In IT staffing, unlike Q2, we have not carried a bench. In addition, IT staffing business also saw a reduction in SG&A to the revenue ratio by 200 basis points versus Q2. This has contributed to the margin improvement. We will continue to focus on efficiency and building upon the margin gains made in Q3. Moving on to Global Technology Solutions Platform. The segment posted a highest revenue and EBITDA, revenue growing by 20% year-on-year, 6% quarter-on-quarter, while EBITDA grew by 3% year-on-year and 7% quarter-on-quarter. Connect had a highest ever quarterly revenue at 364 crores, and Allsat crossed 100 crore quarterly revenue landmark for the first time. Associate headcount across GTS crosses a milestone of 50,000. The customer lifecycle management business in Allsat grew by an impressive 22% year-on-year based on the enhanced account mining and new logo addition across North America and India. Non-voice BPO vertical grew by 29% year-on-year. The highlight of this segment was 37% year-on-year growth and in the collection business, which is a validation to our investment in creating a solution-centric business leveraging our digital tools. In platform-based business, that's our HRO platform, Allsec business grew by 16.5% year-on-year as we processed 3.5 million payslips during the quarter. Our North American platform business under MFX grew by 10% quarter-on-quarter, leading to an impressive margin expansion. Moving on to OEM platform. OEM registered a robust top-line growth of 19% year-on-year and 6% quarter-on-quarter. IFMS, that's the facility management business, saw a revenue growth of 19% year-on-year and 6% quarter-on-quarter, while EBITDA grew by 17% quarter-on-quarter. This increase was driven by 22 new logo additions. Number of meals served in our food business continues to move up, registering around 7.5% quarter-on-quarter growth after growing by 5% quarter-on-quarter in Q2. This resulted in 12% quarter-on-quarter growth, increasing in Q3. The continued focus on efficiency improvement through technology combined with economies of scale have seen our associate to core ratio in our facility management business moving up from 95 to 100 in Q2. Terrier continues to ramp up the headcount. The headcount addition stands at 22,000 with an increase of 5% quarter-on-quarter. As a result of business achieved a revenue growth of 5% quarter-on-quarter. Terrier now holds Pasara licenses in 23 states and our application is under process in 3 states. Our India presence will drive the growth in this business. Vedant, our telecom platform, which focuses on active infra services business, has had its best of quarter in terms of revenue and EBITDA, achieving 9% increase in revenue and 4% increase in EBITDA on quarter-on-quarter basis. We expect strong trend to continue on the back of 5G rollout. Moving on to product-led businesses, where we continue to make significant progress. We rebranded Monster into Foundit to reflect our vision of transformation from job board to complete talent platform. The new brand identity was received very well by all stakeholders. Monster continues to log impressive number with sales crossing INR 40 crore milestone, sales and revenue growing by 40% and 23% year-on-year respectively. Sales grew by 35% quarter-on-quarter sequentially, showing a robust growth even as the hiring scenario slowed down. The candidate traffic and engagement continues to be strong with 6 months active candidate base almost touching 18 million for the first time. Customer acquisition continues to be healthy with over 2,000 new customers contracts for last 6 quarters in a row. New product development has seen significant progress with launch of key AI-driven features on the product as well as the launch of our assessment platform, Skillist. QJob saw an external customer count growth of 15% over quarter-on-quarter, and the NPS continues to be the strong and best in the industry. The cash burn in this segment is as per our expectation and in line to the prior communication that we have made. Coming to corporate updates, we closed Simplines sale transaction. The transaction valued Simplines at an enterprise value of 120 crore against our original investment of 4.5 crore for a 53% stake. This has contributed about 53.5 crore to the profit before taxes in Q3. In line with our capital allocation policy, we have paid interim dividend of 8 per share for FY23. So that was an overview of business, and now I'll pass on to Kamal. Kamal, over to you.
Thank you, Guru. I extend a very warm welcome to everyone who have logged on for my maiden analyst call. Let me now walk you through the Q3 financial performance. Our revenue in Q3 grew 4% compared to previous quarter and grew 21% on Y-on-Y basis. All the segments posted a decent top-line growth. Our EBITDA in Q3 was down by 19% on a Y-on-Y basis to 145 crores. This decline is due to the following reasons. Product-led business burn of 30 crores, which is in line with our previous guidance. Increase in SG&A cost by 7 crores. Contract renegotiation in IFMS business at the start of this financial year, impacting 5 crores. And investment in US staffing business of 3 crores. Our EBITDA in Q3 has grown up 8% on quarter-on-quarter basis, mainly due to growth in GTS and WFM segments. Now to segment-wise updates, starting with WFM. Segment revenue has grown by 4% quarter-on-quarter and 21% year-on-year, driven majorly by general staffing. GS business has added 56 new clients this quarter. As mentioned by Guru, manufacturing has been a bright spot, with 50% of new clients coming from this sector. While the stress on IT staffing continues, cost control measures coupled with productivity push and volume growth helped the platform EBITDA grow by 8% quarter-on-quarter. Coming to GTS, it has been the star performer this quarter. The segment has shown 6% revenue growth quarter-on-quarter and 20% year-on-year, mainly coming from BFSI and IT and ITES. EBITDA for this segment has grown by 7% quarter-on-quarter and 3% Y-on-Y basis. Stable growth and healthy EBITDA margins from this platform re-emphasizes our vision of being a full-fledged business services company. Moving on to OAM, the platform registered a top-line growth of 19% Y-on-Y and 6% Q-on-Q due to continued demand in a few key sectors like BFSI, healthcare, and manufacturing. Food business continues to grow as the education sector has opened up fully, reflecting growth in quarter-on-quarter. EBITDA YOY dip is due to key client contract renegotiation at the start of the financial year. In product-led business, in Q3, Monster was rebranded as Founded. This platform continues its cash burn as per our previous guidance. The sales for Founded is up 40% on Y-on-Y basis. Moving on, OCF stands at 47% of EBITDA, lower compared to previous quarter on account of few key collections moving into January due to year-end holidays in December. We see OCF coming back to our guidance of 70% on a full year basis. During the current financial year, our gross debt has increased by 7% and is presently at 632 crores. Our DSO has increased by 1 day during the quarter. Finance costs has gone up by 10% quarter-on-quarter on account of increased debt and rising interest rate scenario, We are confident of bringing this down in quarter 4 by reducing our average debt levels. Depreciation has gone up 3% quarter on quarter due to increase in lease rentals classified as depreciation under Ind AS 116. As part of corporate structure simplification, our divestment in Sempliance Technologies was completed in October 2022. Consolidated net profit of 86 crores includes profit on sale of these investments to the tune of 53 crores. Income tax update. During the month of December 2022, the objections filed by us against the draft assessment order passed by the Income Tax Department were heard by Dispute Resolution Panel (DRP), and the same was disposed of. In line with the directives of the DRP, a final assessment order was passed by the assessing officer as on 30th January 2023 for financial year 17-18. As an outcome of the order, we have received tax adjustments to the tune of 198 crores, on which a tax liability of 68 crores has been computed, which mainly pertains to two matters, that is 80JJAA deduction claim and depreciation on goodwill. Both these are industry-wide issues, not specific only to Quess, and we intend to vigorously contest our position, and we believe we can strongly defend through the legal process as defined under the Act. We are partnering with BCG to do a strategic review and planning exercise with the goal of sharpening our business and capital allocation priorities in order to drive strong and sustainable long-term value creation. We expect this assignment to continue through the upcoming quarter 4 and Q1 of next year. Our focus for the next 2 quarters is going to be around reducing our SG&A cost, enhancing collections, and bringing down DSO days and reducing our debt levels. We thank you for all your continued support, and I would like to now open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. Ladies and gentlemen, you may press star and 1 to ask a question. The first question is from the line of Vidit Shah from IIFL Securities. Please go ahead.
Hi, just one clarification on your opening comments. What was the growth in general staffing headcount, did you mention?
Okay. Year on year, general staffing has increased by 25% year on year. That is, stands at 379K as of 31st December.
Got it. So just a follow-up to that is, we continue to, grow very significantly despite a high base compared to, some of our competitors. And this has been observed, quarter after quarter. So just wanted to understand what, stands us out versus the industry in the sense, are we able to price lower and win higher business given, higher operating efficiencies in terms of core to associate and all of that? Or is it just a better recruitment reach that allows us to grow much faster than the rest of the industry despite being market leader?
Sure. So, multiple things. One is, of course, the underlining for all of this is the kind of efficiency in hiring that we have built, the multiple channels that we have built over a period of time. And Q3 was the most, I would say, the slowest quarter compared to last, 6 quarters. And even in such a situation, we were able to backfill about 36,000 people across group. The sheer capability comes in the kind of investments that we have made on our hiring platform. So whether it is channels that we have built or the kind of the efficiency and speed that we have built in hiring people, plus the sheer reach of Quess across the geography, throughout India. So that definitely plays a role, and how quicker and faster we can hire and onboard is something we are definitely ahead than anybody else in this segment. So that sets us apart. Having said that, I mean, pricing does not really mean, to answer your question, it is not all about undermining the pricing. It's the capability that we have built in terms of hiring, how we are able to differentiate ourselves in the market.
Guru, if I may just add to that, the question which came in from Vidit. Hi, good morning. This is Lohit here. You asked a very pertinent question, and this has been on every investor's mind for the last, I think, couple of years now, since the last 5-6 years when our general staffing team became the number one in this segment and continues to grow. I think there are few investments over the years which Quess has made, and we continue to sharpen on that investment as far as our general staffing India business is concerned. One clearly pointed out by Guru and Kamal also is sales. If you look at the number of sales, new wins in this year itself is 230. In Q3 itself, there have been 56 sales wins. Number two, every 2 to 3 years, we've looked at an industry segment which would make us the market leader in the next 2 to 3 years. All of you being old-time investors and tracking Quess would remember, till 2017, it used to be retail and consumer. In 2017, we had taken a very clear focus to be the number one in BFSI, and today BFSI is over 100,000 people for us in our largest segment. And in the last 12 months, we've clearly focused on manufacturing and EMPI. Our growth in manufacturing segment and EMPI itself is 67% YTD in the last 9 months itself, and one of the fastest across all the segments that we work. So sales clearly is one. Number two, which Guru again alluded to, is our sourcing efficiency and the size of sourcing. See, Quess has 96 offices across the country. It completely takes anybody else by storm when you have 450 recruiters out there and 96 offices. You couple that with the technology investments under our product-led business, namely the Q Jobs, the Work, and the Dash. As they layer with our associates and our customers, we get a first mover advantage and we get a massive addition to our operating size and our sourcing. And last but not the least, I think the processes. We spoke about 5 years ago that we made a small investment through Heptagon in a process called POP, paperless onboarding process. Today, that has defined the entire industry itself. In less than 7 minutes, anybody in any of the remote corners of the country gets onboarded to Quess, and we don't have dropout ratios because of that efficiency and that technology. And that is how we are able to add about 30,000 people and more every month as a gross add. So I think these are the things which will continue to set us apart. Our teams continue to make these investments. As long as we keep bagging new customers, we'll keep investing in technology, sourcing, and sales.
Okay, thanks. Thanks for that detailed clarification. The second question I had was on the Monster. If you could just clarify, out of the EBITDA loss of, let's say, 27 crores in 3Q in the product-led businesses segment, how much of this could be attributed to Monster?
Kamal here. I will take this one. So out of 27 crores, 25 crores pertains to Founded, Public Monster.
Oh, sorry. Yeah, got it. So now that we've burnt a significant chunk of our externally raised money in Monster, so Founded. It's been three and a half odd quarters that we've been doing this. What's the sense going forward? Are we close to raising more capital, or is this likely to come to an end in the next couple of quarters, and then are we expecting it to break even soon?
Yeah. Hi, this is Shekhar here. We are well within our plan in terms of the operational burn on Founded. However, I would like to correct you that whatever external capital we have raised, we still have significant amount of capital in the bank, and it is in line. We are well capitalized with what we have in the bank for at least the next 18 months. And the operational plan, both in terms of growth in sales and revenue as well as the burn, is in line with what we have shared earlier. And as per the guidance shared earlier, we are expecting to break even by Q4 of next year.
Okay, so it's fair to assume that this 25 odd EBITDA loss, or maybe a little lesser in cash burn due to ESOPs and all of that, would continue for most of next year as well.
Would continue to go down and taper down to becoming a break-even point by Q4 of next year.
Okay. Understood. And just one last point on, the exceptional item and the tax claim that we've had. You mentioned the 68 crore tax claim. Is it possible to break this down between how much is, on account of the 80 JJAA disallowance and how much on account of the depreciation on goodwill?
Sure. Kamal again. So thanks for this question. And let me answer this holistically because there's also a question around contingent liability and the disclosure that we have done. So this is for financial year 17-18 where we had gone through the DRP process. And as explained in my speech, what we are left now is only these two principal matters, which are again not specific to Quess. So all matters pertaining to Quess got disposed of during the DRP hearings. The breakup of 198 crores is 68 crores on 80JJAA and 121 crores, which is on depreciation of goodwill. And the tax liability on that comes to 68 crores. Against that, we're sitting on a MAT credit of close to 41 crores. So our contingent liability for this financial year comes to 27 crores, which as per our previous guidance and as advised by our tax advisors, we had mentioned 17 crores. So the 17 crores from a contingent liability disclosed earlier goes up to 27 crores. What we disclosed in the financial statements is the contingent liability of 74 crores, which includes contingent liability for financial year 17-18 and financial year 18-19, for which the DRP hearings are yet to commence. But going by the order that we have received for 17-18, we continue to assume to continue to get the similar order for the next financial year. The contingent liability for the subsequent year is of 47 crores. So both put together is the 74 crores, which we have disclosed in the financial statements.
Okay, and what's the sense that you get for the subsequent financial years, 2021, 21, 22, and even 22, 23? I mean, if this assessment were to be upheld in even higher levels of court, what's the tax outflow and maybe an expense to the P&L that one could likely see in the upcoming years?
Sure. This is Kamal again. So, see, for all subsequent financial years, as of now, since the assessments have not been done, we will not be able to quantify as to what we will get from the income tax department. However, the settlements in our country is actually a multi-stage process. So we've gone through the assessing officer, we've gone through the DRP. The next stage for us, for this financial year for which we've got the final order, is we're going to go through the tribunal process. The two positions, one of them is a settled Supreme Court position, and we are very confident of receiving a positive order in the subsequent stage. And the 80JJAA matter is again something which is an industry-wide matter, and we believe that, as per the advices from our tax consultants, that we have a strong merit in what positions we have taken. To your question on cash outflow, we do not have any outflow exposure, because considering the contingent liability as well as the refunds that are outstanding with the department, even if for all subsequent years going up to the last financial year, FY21-22, the entire 80JJAA as well as depreciation of goodwill, if were to get disallowed, we still have sufficient MAT credit and refund spending. So from a cash outflow perspective, we have zero exposure.
Okay, got it. I'll get back in queue for this question. Thank you.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Darren from Fourth Investment Management. Please go ahead.
Hi, I'm Darren from Fourth Investment. I have two questions. It's mainly on the GDS segment. For the GDS, can I ask what were key drivers that led to the improvement in EBITDA margin for this quarter? And second question is, what is the management outlook for the GDS EBITDA margin in financial year 2024 and 2025, as well as the assumptions and risks behind it? Thank you.
Darren, can you please repeat the question?
Oh, for the first question is regarding the GDS segment. So what were the key drivers that led to the improvement in EBITDA margin for this quarter?
Okay. GTS as a platform, our EBITDA margin is 16%. That's where we are currently at aggregate at a platform level. And the question is, what are the drivers? Of course, I mean, under GTS, we have three platforms. The first one is Connect Business Services, which is Customer Lifecycle Management, domestic, and then we have non-voice, BPO, and we have HRO platform. So these are three businesses which are stacked under GTS. Now, domestic business operates at an average EBITDA margin of about between 14 to 15%, and continues to have a fantastic outlook in terms of we command the second rank in terms of ranking in the business in the country. Our volumes have been substantially high. The growth in this business itself is, we are able to command at least about 20% year-on-year growth and sustain at that level. When it comes to specific to non-voice BPO, what we focus is on the collection business, which is a kind of hybrid between digital and the physical collections of outstanding for various financial fintech institutes. There we have been seeing a fantastic growth, about 29% year-on-year. And the third platform is HRO, where we do the platform of payroll processing and outsourcing of payroll. There are payslips, number of payslips that we process is growing at 16.5% year-on-year. So again, a high margin business contributes close to about 20% plus EBITDA margin. So combination of all these three averages at 16% in terms of contribution.
Understood. The second question is, what outlook for GTS?
Sorry. Hi, Darren, this is Pinaki from New Jersey. Am I audible?
Darren, sorry, but then your voice is coming a little muffled. May I request you to speak through the handset?
Yeah, can you hear me?
Yes, better than before. Thank you.
Go ahead.
Yeah, so thanks, Guru. Just to add a color to that, if you see the composition of the GTS business, like this quarter, 560 crore odd, right? Out of that, platform business is around 91 crore, which is at an essentially higher margin because there we have the marginal cost principle, right? The more the volume increases, because due to the platform nature of the thing, the incremental margin increases with incremental revenue. So that can range from a high of 35% EBITDA for the HRO business to 25 to 28% for the InsurTech platform. Whereas the composition of the CLM business, there is around, currently we do around 330 crores of essentially voice business, and the 230 crores of essentially voice business, and rest are non-voice BPO, which are at higher margin level. So on the voice, it's more of an efficiency game, 14, 15, 16% within that range we keep, depending on domestic versus international. International comes at, the North America business comes at 20% plus, whereas the domestic comes at that kind of a range to give a blended margin of that. So the bigger drivers here to your question is, the more the volume in the platform business increases, obviously the margin percentage goes up. The more on the either the F&A outsourcing or collection on the non-voice side of business increases, the operating margin goes up. Whereas the voice is more of an efficiency game where we are actually the cost leaders in the industry now. So overall we get that blend, and generally you have seen over the last 8 to 10 quarters, your continuous increased margins and have ranged between 16 to 18% at the at the higher end. So that's the play that we have based on the composition that we take, and some quarter-wise fluctuation obviously is there based on, like this quarter we had a 37% year-on-year growth on the collection business, whereas rest of the business grew at 20 to 22% range. So some fluctuation happens obviously in the margin based on that. Whereas in HRO platform, we had a 16.5% growth. In the quarter where HRO grows 25%, obviously the margin goes to that extent. Those are the main levers that are there.
Got it. Thank you. That's very useful. Just one final question on the WFM segment. I understand that Quess has been investing in the U.S. staffing business. I was wondering when is management looking to break even in that business segment as well as start contributing, as well as for the U.S. staffing business to start contributing to the margin?
Hi, again, this is Good Morning Lohit here. So the U.S. staffing market was started by us in the summer of 2022. We've just had a little over 2 quarters of performance there. In the initial stage, up until the numbers that are in front of you, which is for the October, November, December Q3 financial year 23, there is no revenue which is booked and there is no revenue which has proceeded into these numbers. However, as we have come into Q4, some of the customers which we had bagged in the last 3 months have started to convert into open orders and demands. Our units, which are delivery units, are in India and Philippines, have started to deliver against those. And glad to report you that the first set of invoicing and billing has begun. But this would all fall into our results and our numbers for the Q4 period. Like we mentioned in our last quarterly call, we are looking at a break-even from this unit between this and the coming quarter, which would be the time by when our US operations would have seen 1 year. So they see 1 year of operations around June of 2023. Before that, we would attain our break-even. You would know, and we had spoken about this last time as well, the US staffing market for WFM's growth strategy is very, very integral and important for the medium term, which is 3 to 5 years ahead of us, because not only it gives us large volume and revenue and top line, it also gives us a very healthy margin profile at the bottom line. So we would start to see changing color in the new financial year as US starts to contribute to revenue streams. I hope that answers.
Yes, that's helpful. Thank you so much. That's all from my end.
Thank you.
Thank you. Participants, you may press star and 1 to ask a question. Next question is from the line of Amit Khetan from Laburnum Capital. Please go ahead. Amit, may I request you to unmute your line from your side and go with the question, please? Amit,
hi, can you hear me?
Yes.
Yeah, sorry. Good morning and thank you for the opportunity. Just 2 questions. One is on the workforce management. Would it be possible to share the EBITDA split between the general staffing, IT staffing, overseas staffing like you have for revenues, say for the 9-month period?
We can send you the details over a one-on-one. However, having said that, at an EBITDA aggregate level, the general staffing India business currently contributes 50% to the overall EBITDA of WFM, while the balance 50% coming from professional staffing India, professional staffing international and others. Within international and India, at the moment, as you know, India IT is reeling under some degree of pressure. Hence, they are half of the contribution which is coming from international. I must also add, at this moment, we are seeing a bit of a negative, as we just explained in the last question, because of the investments made in US. US is yet to get to the point of break-even. As that happens, international should further grow. And like has been mentioned in the last couple of calls, our focus at Quess and within WFM leadership team is that over a period of time, on a healthy growing general staffing, we should have general staffing come down to about 40%, whereas professional staffing and international staffing take over the balance 60%, which is how the margin mix of WFM would change.
Got it. That's very helpful. A second question was, wanted a clarification on the IT issue. So if I look at your listed competitor Team Lease, right, they have their income tax is pending only for FY22, while we have assessments pending from 17, 18, and which have been disallowed. Given that we are basically contesting on the same issues, why is it that our matter has been disallowed, while theirs has gone through?
So Kamal here, see from an income tax point, comparing two companies, even sometimes comparing to assessment years becomes difficult because in income tax each assessment year is seen separately. We've gone through, like I explained in my previous answer also, we've gone through a multi-stage process here. So for one of the years, the assessment is completed and we are going through the tribunal. For the second year, which is FY18-19, we are into DRP and we expect the hearings to happen over a period of next 6 months. And for 19-20, the assessment from the department itself has to get closed. I do not think that it is something to do with differentiation between how a competitor vis-a-vis. It's just this is the queue that the department takes each assessment year one after another.
Got it. No, I was just wondering because we have the same issue, right? Section 80 JJAA, and I understand if the goodwill part is a little different, but at least for this issue we should have got a resolution like that.
Yeah. So goodwill, depreciation on goodwill again is something which is very clearly there in the law. The section allowed depreciation on goodwill as a deductible expenditure up to financial year 2021, which is where we have claimed it up to that year, and subsequently there was an amendment in the law which disallowed claiming this as a deduction, which we have also done as an organization. The dispute here is for the periods prior, where department is trying to do a retrospective application of an amendment which came in financial year 2021. And as explained, we're confident because there are settled judicial precedences going up to the Honorable Supreme Court level where such deductions have been allowed.
Got it. Thank you and all the best.
Thank you, Amit.
Thank you. Ladies and gentlemen, you may press star and 1 to ask the question. Next question is from the line of Mukul Garg from Motilal Oswal. Please go ahead.
Hello. Yeah, I hope I am audible.
Yes, Mukul.
Yeah, so I had two questions. First for Guru and Lohit. Guru, you initially in your initial commentary you mentioned the demand environment kind of being a bit weaker. Can you do a bit of a crystal ball gazing in terms of how do you see the overall, especially for general staffing demand outlook in the very near term, next 3 to 6 months? Will things be continue to be a bit more muted, or are you seeing signs of demand pickup or increased use of kind of general staffing setup being used by corporates across the country?
Sure. Well, as you know, generally the peak season for staffing starts somewhere in the month of June and ends slightly later part of Diwali, which is last year if you were to compare, Diwali used to be sometime in second week or first week of November, and this time Diwali was early, so that contributed to little more quicker offloading for Q3. So that's one of the element which impacted the demand to come down. Second, the natural downsizing and the kind of hiring environment in itself, sentiment itself was down. So again, the active industries were specifically called out. BFSI, we did good set of hiring. Manufacturing, we actually, our headcount is almost is crossing about 50,000 only in manufacturing segment compared to previous year. FMCG and FMCD continue to grow. So these were the segment which really contributed to the kind of backfill of 35,000 headcount that we saw being offloaded, and we were able to fulfill that through the backfills. Having said that, again, Q4 is, the few segments which I called out continues to stay active, that is manufacturing and BFSI. With budget again reinforcing and reorienting investment into infrastructure, we see this particular segment continue to stay strong for coming years. So, I mean, there are large manufacturing centers which are being set up. So we are having early stage conversation with few set of customers. So we are seeing a good set of activity happening there. Barring that, logistic and supply chain was a bit of a disappointment compared to Q1. I mean, the multiple ways of delivery and outsourcing that these companies are thinking, and the captive last mile delivery is slightly reducing. More of deployment are onto warehouses and sort centers. So that's a bit of a low demand which is coming into. Telecom, of course, I think we will see little more getting active because 5G is going all over. So that's going to be another addition in the coming next 2 quarters. Lohit, you want to add anything?
Sure, Guru. Mukul, good question. And, just to give you a color, and Guru rightly explained, I think the highest point that we've seen during this year was in the month of August and September. At that point, the demand for just the general staffing India business had reached 36,000 open positions from all our customers put together. That kind of a demand we have never seen. Obviously, you have to also agree that we are adding 300 customers every year. So obviously demand will keep growing. Having said that, it has tapered after that. And like Guru rightly explained, for October, November, December, I don't want to repeat that. As we come into Q4 and we look at, let's say January and the other months, we are looking at an open demand position of about 25,000. So if you were to say that where is it from a crystal ball Q4, it's about 30-35% lower than the highest ever. However, it continues to remain at historical highs if this itself continues to remain as an open position with us. That's point number one. Point number two, and I think Guru very rightly mentioned about the budget and the capex spend again increased by 33%. The large mega manufacturing setups which are coming in India, and in those setups, we are expecting consolidated deals to be signed. You must appreciate, and I'm sure all of you agree to the fact that Quess is truly a business services entity. We can have people in a plant from the front gate with security services, man guarding, surveillance security. We can give food services. We can provide janitorial services. We can provide assembly line workers. We can provide IT workers. We can provide all the HVAC and engineering support services and all. Today, the kind of conversations that our OAM and WFM teams are jointly doing are to bring customers which want mega suppliers and mega business services companies. And all of these services can be given under one situation. I think the medium term, we are going to see a very different kind of deal flows happening, which is what we are within WFM, OAM, and the other portfolio working extremely hard. At the right time, we would also let you know we are tailor-making these into product suits itself, but we would like to win a few deals before we start those announcements.
Great, very helpful. My second question was to Shekhar. Shekhar, two-part question. First on the business side, this quarter, most of your metrics, reported metrics were down versus the last quarter, while your sales were up. How should we read them, given that obviously the demand side has weakened considerably, while supply side has obviously continued to ramp up as people are let go. Should we expect a bit of a moderation in sales over the next few quarters, which down the line will have an impact on revenues? Or was the weakening kind of queries or visits this quarter was a one-off?
Thanks for the question. So in terms of sales, I'll address it in two parts. In terms of sales, we had a very good quarter. We grew by more than 40% year-on-year and more than 30% quarter-on-quarter. So if the situation externally was better, we could have done even higher numbers, but that said, we have very, very aggressive numbers that we've achieved in this quarter. The impact of the slowdown is in some sectors, and some sectors are still hiring robustly. The procurement cycles have become a little longer. That's the only impact we're seeing as of now, but we fully expect, based on what we see going forward as well, that the sales momentum will continue. On the candidate acquisition momentum, our 6-month candidate active base, which is the primary metric that the recruiters see before they buy, continues to grow Q on Q. We had an impact because of the rebranding, because whatever organic strength you would have accumulated over years of running the domains will take 2 to 3 months to bounce back. So that's a bit of a lull that you would have seen in some of the candidate traffic metrics. But the candidate active metric still continues to grow. We are closing on 18 million for 6-month active, which is the highest ever. Going forward, we don't expect the sales momentum to go down. All of our estimates in terms of sales growth as well as our cost are still very much in line with the guidance that we have provided, and if anything, we are doing much, much better. Because as cost pressures come into the companies, they look to divert some of their spends from agency-based hiring to tool-based hiring, which in fact should help some of our sales processes. So for us, simply from a founded perspective, we don't expect too much of a deviation from what we have put out so far. On top of that, we also expect companies to look for more fresher hiring as well as more skill-based verifiable hiring. On both the fronts, we've launched our platform called Zuno, which is doing very well. We've got 500 companies already using the platform, and we also launched our assessment platform Skillit. So from a product roadmap perspective, it's very robust, and all is good on Founded.
Right. And then just to kind of dig a bit deeper into the kind of cash burn expectations we have internally, how much of the fund which you initially raised, both from Quess as well as external investors, is there right now, which you kind of expect to last till Q4 of next fiscal? And were there any commitments which we made to the investor while raising funds in terms of secondary follow-on fundraise or a public listing, which obviously is written into our agreements?
Yeah. So as you remember, we've raised close to $20 million in the last round. At the end of the quarter, we still have more than 100 crores left in the bank. You might also understand that this is a negative working capital business. It's a prepaid business. So as the sales numbers go up quarter on quarter, which is what has been happening for 3 quarters in succession, our cash position will also be very positive and healthy. So we have more than 100 crores still left in the bank, which in our current business plan projections is more than adequate for the next 18 months of operation and beyond as well, because starting Q4 of next year, we would be breaking even and in a positive EBITDA space. So from that perspective, we're extremely comfortable on cash. The decision on how we move on capitalization from here is completely dependent on what we want to do from accelerating our growth perspective, but not mandated by any requirements from operational cash, for which we are adequately covered.
Right. So there is no requirement for fundraise, in terms of timing.
Not really. Based on what we have in the bank currently, we are comfortably placed.
Great. Thanks for taking my question. I'll get back into the queue.
Thank you. Next question is from the line of Alok Deshpande from Nuvama. Please go ahead.
Yeah, thanks for the opportunity. 2 questions. One, if you could give some sense on how is IT staffing environment currently. We know from what we hear from IT companies, it's sort of quite subdued. But your sense on how IT staffing will probably pan out for the next couple of quarters, 3 quarters, that is one. And secondly, Lohit, about the US business, what do you think in a couple of years or 3 years time, what can be, where can we potentially reach in terms of revenue or EBITDA there?
Okay. As far as the IT business is concerned, Alok, what you've been reading and what is being reported in the press is exactly what the scenario and the situation is there. As far as we watched our portfolio, the IT services business is down by about 60%. Now, IT services business only takes care of, it only impacts big time in our RPO business and our permanent recruitment business. IT services in itself is not a very large play for us when it comes to our contract management and Quess IT staffing solutions business. So there the portfolio stability is very well hedged. Now, for the recruitment solutions, which is the permanent recruitment as well as RPO as well, you would remember in the last 2 quarters, we were saying that as we were getting the signs of a bit of a slowdown of lateral hires in the IT services companies, we had also started putting our efforts in non-IT as well as within IT, non-IT services. So glad to report to you that from the bottom of where we were in IT services, we probably inched up by about 5 to 10%. When I say bottom, we were down 60%, so we've just climbed 5 or 10% on that. However, IT business, which at that point of time was barely 9% contribution to the entire business, today contributes about 26% of the business. So non-IT is quickly galloping and taking space within the IT services. We feel going ahead for 2 more quarters, which is Q4 and Q1, we should be watching this space very, very closely and continue to do what we are doing in the non-IT piece and strengthening our overall portfolio. So that will continue to happen. Guru and Kamal both mentioned on something related to cost. I think across the WFM portfolio, we are trying to see how can we become more cost efficient and competitive. While we are one of the most cost competitive and efficient organizations in this business, however, we would like to increase our efficiencies and productivity even further. So across the entire portfolio, that homework is also going on, which will also see some degree of improvements in Q4 and Q1. Coming back to your question on US and where could we be 3 years from today, I'll just give you a broad context. It's very difficult to define what EBITDA might come 3 years from today, while our plans are for 3 to 5 years, and which is why we've entered the market. So India's staffing industry is now hovering around the 0.9% kind of a penetration. It has inched up from 0.6% in the last 6 years to 0.9%. I think the latest reports coming out of all the federations is hovering around this mark. It's a $14 billion industry. The US market is a $160 billion industry. While India is growing at 21%, US is growing at 9 to 10%. So US still continues at single digits, also continues to add one India staffing in its market every year. The second data point, while a lot of job losses are being spoken about and some of the large brands are also asking people to leave and it's there in the public domain, the jobs open for every American who's qualified and is a white-collar IT worker is 1.8 times. That means for the number of candidates available in US to the number of jobs available, it's the number of jobs are still 2x of that. The third data point is that the business that we are getting into would do a revenue PAPM of around $12,000 to $13,000 per associate per month, and the market there does a gross margin of about 20%. So if we are able to do between the 2 to 2,500 gross margin, I think you can very well anticipate and see what kind of numbers, both in terms of top line revenue and bottom line accretive, it could be towards the WFM platform. I hope that helps with what was in your mind, Alok. Otherwise, we can have a more in-depth one-on-one as well on this.
Sure. Just to add, Alok, I think you also had a question on where is the demand that is coming from. Specific industry, if I may were to call out, it's from auto, engineering, digital, and 5G telecom. So these are the key active areas where we are doing technology hiring currently.
Sure. Thanks, Lloyd. Thanks, Guru. This is very detailed indeed. Lloyd, just one clarification. You mentioned this part of it is down 60%. Now, if you see the way the businesses are classified now under various segments. So this 60% fall would come under the professional staffing sort of subsegment or somewhere else?
So the 60% would come under the professional staffing India's sub-segment, which is recruitment services, which is lateral hirings. It's permanent recruitment business, not the contract IT staffing business. Contract IT staffing business, as I mentioned, does not have a very high IT services exposure that continues to be reasonably, well placed.
Okay, so this is a small part of the 20% of the WFM, if I read this correctly, right?
That is right. But Alok, this is permanent recruitment is a high margin business. It's a 30% gross margin business. So when it shrinks, it creates a bit of a issue across the margin profile. So we've seen the worst of that. Now we are rising from there.
Sure. Thanks, Louis. I'll connect with you separately.
Sure.
Bye.
Thank you. I now hand the conference over to the management for closing comments.
Thanks, David. So, I take this opportunity to thank you all. It's this community for your continued support and to us for our institution across. Going forward, our focus, as always, will continue to be on focus on growth. Will not take our eyes off. Driving cost optimization across all platforms, corporate structure simplification, and debt reduction. So these are top priorities for us. And thank you, and thanks for joining this call. Look forward to interact with you also.
Thank you very much. On behalf of IIFL Securities Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.